Justin. Those who don't know me, I'm Business and Tourism Advisor at Sutherland Shire Council. Before we get started, I thought as the host of this webinar, we'd just do a quick acknowledgement to country. So Sutherland Shire Council acknowledges the Dharawal people as the traditional custodians of the land within the Sutherland Shire. We value and celebrate the Dharawal culture and language and acknowledge the Dharawal people's continued connection to the land and the sea and the community. We pay respect to the elders and their families, past, present, and emerging, and through them to all Aboriginal and Torres Strait Islander peoples. I also recognise the traditional owners of the countries where you are all where you are all based today, and the First Nations people, past, present in this webinar. So thanks a lot.
Fantastic. Thank you, Justin. And thank you so much for the Sutherland Shire Council for making today possible. My name is Jeremy Carter, and I will be part MC and part presenter today on our topic of really navigating our business through some of the economic challenges. And, you know, one of the things with tough times is they also create many opportunities for businesses that are smart enough to look ahead, to see what's coming, and then to really make sure that they fine-tune their business to take advantage, I guess, of the prevailing situation. A little bit on the Sutherland Shire Council Economic Development team who are here to support your small business success. If you haven't been to the website already, sutherlandshire.nsw.gov.au/local business, there's 4 very key resources as local business owners that you ought to be aware of on that website. One is the newsletter Business Now, which will keep you in the loop in terms of what's going on in the local community, different events, and news relevant to small business. There's also the Sutherland Shire Grants Finder. So if you're looking for ways to grow your business and other support that's available to your business through grants, the Grants Finder is a terrific way to be able to get there. The Business Success Series, so we've got a series of 3 different workshops, and all of these workshops have come from your feedback in terms of the business survey that Council sent out last year. And there was a lot of feedback around, well, we see times are tough, how do we do better? So that's really where the idea for this webinar came with. And the 4th area is around business intelligence. And we're lucky enough to have Keenan Jackson from ID, which stands for Informed Decision, here today. But if you go on the Sutherland Shire Council website, you actually have access to the ID platform. And this is a brilliant tool that harnesses all the data from the census that allows you to look at what's happening in the local community, where to find the customers that you really want to go after, to be able to sort by region, by demographic. So it's a very, very powerful tool for existing businesses and also for new businesses. You know, as the saying goes, if you want to go fishing, go where the fish are. And the ID suite of tools for business owners is a very powerful fish finder to allow you really to target in on your ideal audience. The email address, economicdevelopment@sutherlandshire.council, ssc.nsw.gov.au. So a little bit of background on myself, how I come to be here. I'm actually a corporate refugee. So I started my career as a computer engineer and went to work for a large US technology company, growing through the ranks to become Oceania Managing Director. It was 22 years ago that I left the corporate world to really get out and support small business. So I've worked with a lot of businesses over the time, and one of the big things that really helps businesses succeed is to be clear on what they want, to have the vision, to have the goals, and to have a plan. And as a business coach, that's one of the things that I specialize in. So there's an offer for everyone attending today. If you'd be interested to do a one-to-one business growth discovery session, there's the link there that you can book in, and happy to have a conversation with you about some of the things that may be challenging you right now, how to get through that and move your business on down the line. Now, get your pencils ready because we have a lot of content coming your way. And again, ask questions as we go using the Q&A session. You can drop ideas and insights and thoughts into the chat as well. So I want to start with perhaps a little bit of a scary thought. 52% of the Fortune 500 companies from the year 2000 are now extinct. And these were some absolute market leaders. They were in positions of complete dominance. When we look at over the historical context of things, extinction tends to be the norm rather than the exception. You know, if we look at the data from Australia, 20% of businesses fail in their very first year, 60% fail in their first 3 years. And what we want to do today is to give you some context and some very useful tools that will help you avoid being a dinosaur in business. So first up today, Keenan will be presenting on the 2025 economic outlook. What do we see coming in the next 12 months? And more importantly, what does it mean for your business? Then we'll be doing a deep dive on property. And property is an amazing strategy for any business owner to be able to build wealth. And we'll talk about that with Vanessa and Brad from today. And then we'll have a discussion around future-proofing your business, managing costs and risks, and then an open Q&A. So I'm going to throw it over to Keenan from Informed Decision. Informed Decision is a business that empowers local governments and industry partners with online tools and consulting services to inform place-based decisions. Keenan, what we need to do is to allow you to share your screen. Are you good to go with that?
Yep.
So I've stopped sharing my screen and you're good to go.
Right. Okay. Everyone see that? Yep. Great. Okay. Well, thanks for the intro, Jeremy. I mean, that was a great wrap for our business, Informed Decisions. As Jeremy mentioned, we work with a lot of councils all around Australia, and our main thing is getting data online, free for anyone to use. So it's population, it's forecasting, it's local economic area data, which no one else really does to a level of detail we do in Australia. And it's all there for anyone to use, sponsored by your local council, which is really good. We've got a housing product as well, which looks at supply and demand of housing and affordable housing in the area. And we've also got a community views product, which we use to sense check livability and community sentiment within local areas. But today we're talking about the New South Wales and Sutherland economy. It's a good chance for, quite often you're running small business, whether or not you're reading the local papers, keep up what's going on or not, it's a good chance to just sit back and take a stock of what's happening. You may already know it. If not, you may get a few pearls of wisdom or not otherwise. Today, I'm going to touch on the New South Wales economy. So this is the last financial year that finishes last year. And what we say when we compare to the rest of Australia, New South Wales is running lower than most areas. And that's partly because there was a few states like WA and South Australia, which were running quite hot, which is not extraordinary for WA. They're rebounding through a new kind of semi-mining boom or exploration boom. It is new for South Australia, who had about 20 years of pretty flat growth. So it's quite extraordinary what's been happening there in the last few years. But New South Wales, lower than the average for gross state product, lower growth than average in employment growth, lower population growth, which some people like, some people don't. Inflation had moderated. And even house prices were lower than the national average, which was unusual, especially for Sydney. Unemployment still pretty good, and we see that across the country. But we know there's two different stories there with unemployment. We'll touch on that later in terms of where the employment growth is occurring. But what's happened since? So hang on, this slide here just looks at kind of the history of the last decade, and we see that big COVID drop in 2020, bounce back. Big boom years, so it's only natural that the economy was going to fall back a bit. Most of that fallback was actually due to some of the export values in the coal market as well. But we can see there a lot of what was driving the economy, and people know this by reading newspaper, is government expenditure. And we see this especially in the two biggest states of Victoria and New South Wales. It's either government expenditure on policies, NDIS and other things, or it's government investment on big major infrastructure projects as well. Interesting to note there, private investment was up, but it wasn't in physical things, it was in tangible software. We've seen this, there's a very big investment, whether it's to do with AI, some of it probably is, but a huge investment into software within firms in the last couple of years, highest that it's been for a long time. If we look at employment growth, once again, follows similar trend, big drop in that 2020, high bounce back in that, but a more moderate growth. And we're seeing a number of sectors where there's been a bit of a decline in full-time employment replaced by more part-time. And typically the high-growing employment sectors, healthcare and retail, healthcare, and accommodation for the last couple of years, there's more casualisation of that area, so less kind of part-time employment. What's happened since June? So what happened in the end of last year's kind of quarter? Well, New South Wales kind of turned around a little bit. So state demand was up. Employment growth was reasonably, stronger than what it was. Inflation dropped away. And retail trade had a reasonable quarter in that December as well. And unemployment rate was pretty much unchanged. So a little bit better than what happened in the year before that. But as you can see, the employment growth here, the growth in job hours in the year to September, 4.3% growth in the non-market sector. So that's government sector. So it's really that story about government not only leading expenditure, but a lot of the employment growth. And you see that June to September quarter there, healthcare and social assistance is pretty much just dominating most of the employment growth. And we see that right across Australia. It's just a phenomenal amount of jobs growth in there, led in part mainly by baby boomers getting older and requiring more demand with chronic illnesses for services and trying to keep up with that. A large amount of the developments in most of the states is hospitals. I think Queensland has about 4 hospitals they're building over $1 billion each. There's one of the largest projects ever in South Australia is the new hospital there, over $3 billion. There's a hospital down the road from me that's $2.5 billion in Footscray. So the healthcare sector is dominating there. And you see the private sector still had growth, but much, much lower. So what's happened because of all that health growth? Well, we've seen a huge change in female participation rates. So since COVID, we've had the male participation rate is unchanged, but the female participation rate is catching up, 3.3%, which may not sound like a lot, but actually when you put it across Australia, it's thousands or in tens of thousands of actual people in New South Wales. These stats in New South Wales, it's an extra 70,000 females employed since COVID compared to males. So there's a bit of a convergence. Female employment is certainly catching up, and that has implications. Demand for childcare services. Also, more women in employment means more access to incomes, basically, and their spending as well from an individual level. Business confidence in New South Wales is pretty much bouncing up and down, certainly flatter than what it was a few years ago. But, confidence is an interesting thing. Confidence was running very high in 2021 when we were coming out of COVID. We're probably just more going back to kind of normal kind of conditions at the moment. But having said that, the surveys say that still 30% of businesses plan to grow in the coming year, and 1/3 to half of them plan to hire more staff in the coming year. Looking at housing activity across the state. So we know we had that huge kind of jump in approvals fueled by very low interest rates and by government policies pumping up people to go out and demand new housing, basically, at a state and national level. So we had huge approvals. That's flattened off. That's fallen away since that 2021 period. And it doesn't matter how many approvals you want. Doesn't mean you can actually build more dwellings, and that's what we've seen basically. Dwellings, the amount of commencements and completions have actually fallen away in the last 5 years and been pretty flat, but there has been a little bit of pickup in the apartment activity. And whether interest rates, we're turning the corner there, but it also relies on construction costs as well. And we can see construction costs, no wonder commencements and completions were pretty much flat or falling away in the last 5 years. Look at that huge 30% increase between 2020 and 2023. And this is not just wages, this is looking more at material costs. But the growth since then has been only 2% in the last couple of years. So we've kind of had that huge buffer, and hopefully, and we saw that led to some of the companies going to administration, but those costs are kind of flattened out. But yeah, no doubts, a lot of businesses were doing it tough, not just in construction, and other industries as well. We're finally seeing some real wage growth. So real wages actually went backwards because we had the huge inflation rates that we had above 7%. But in the last couple of quarters, we've seen a positive real wage growth as inflation has started to fall below the wages. So inflation goes up early and then we demand higher wages to meet that. And so wage growth is usually a bit of a lag. We built in some of those wage growth now, and so we're getting real wages, which supposedly will mean that we theoretically have more I guess, disposable income going forward. But you can see we've gone through a period where we had negative real wage growth for a number of years there. Retail trade is flat, but it actually picked up a little bit in December because of Black Friday and Cyber Monday. So some big bounce back in expenditure in electronics in particular, pharmaceuticals, or this kind of health and well-being type things that people are ordering mainly online. Homewares as well. Takeaways picks up. So people are sitting at home rather than going out. And online spending went through the roof during COVID, and it kind of continued more of a slower growth post-COVID. But Black Friday and these sales certainly picked it up. New South Wales, year on year, parcel volumes went up by 5%. So people still shopping online. What was the most popular categories? As I said, health and well-being or wellness type things went up by 20%. Athleisure, tools and garden, homewares and everything. That's what you usually get people supporting. And it's this kind of transition we've seen definitely in the last 5 years with less physical retail spaces, tons of warehouses getting built in the western suburbs of Sydney, and there's more kind of people not having a physical space or a small physical space, but a big online presence, and they're kind of subcontracting sometimes the delivery of their products that people are ordering online. So what's the outlook that the government thinks coming forward? Well, they're estimating that a bit of a flatter growth. They've revised downwards the economic growth for this current year to June 24-25 due to flat state final demand. This is from the Treasury. Population growth has been revised up a little bit because if you look at the current migration data, all the talk of bringing the numbers down, at the moment we're not actually seeing that. And really the federal government is only likely to pull the trigger on what we call long-term migration as opposed to short-term migration. International students is still pumping along very, very high. And a lot of those students will still transition at some point to other visas to work locally. Unemployment, because of the high population rates, is expected to gradually rise going forward. But we're expecting, the state government is expecting a return to stronger growth in the next financial year. So on the flip side, lower employment growth. A note on inflation. So inflation, big talk about getting it under that kind of 3% bar that the RBA talks about. And it has trended down, and headline is below that. But if we took away all those rebates that we gave to electricity, state ones, national ones as well, the underlying inflation rate is still above that 3%. So we're still not quite there. And there will probably be a bounce back in inflation once those rebates are removed. So the Sutherland Shire, let's talk a bit quickly about the Sutherland Shire. Your local industry is dominated by healthcare and social, which we see this right across. It's the largest employment growth in the country for nearly everywhere in the last decade. Retail trade, big employer, construction as well. You've got a huge amount of in construction not in only industrial areas, but a lot of tradies as well live out there. Professional sector as well. Anyway, in Sydney has quite strong professional sector employment as well. But what we're seeing, healthcare leading the growth, also leading the business growth in your shire, which sometimes we don't see this. We see it leading employment growth everywhere across Australia, but contrasting here, seeing the business growth in that sector is quite, I wouldn't say unusual, but it's a difference we see in your shire compared to other areas. So there's a lot of people taking opportunities in that sector, and that includes disability services, healthcare and social services, also includes childcare services as well as allied health services. So a lot of people starting new businesses Construction business growth is strong, and rental, especially in that last financial year, big strong growth in rental and real estate services as well, which maybe a bit of competition for some of the other speakers coming on today, but whether that's sole traders in that areas. Moving to population growth, bounced back strongly. That looks quite abnormal, that growth in the 2022-23 period there for your shire. But we've got to acknowledge the fact that a lot of people left during COVID. So, and you tend to get quite a big international migration for China. And we know a lot of Chinese went back home during COVID and they couldn't get back, or they didn't feel comfortable leaving China to come back to Australia, because China, it wasn't until early 2023 when they changed their policies in China, allowing people to free movement back and forth from China. So people didn't feel comfortable leaving the country if they didn't think they could get back. So a big growth there, which goes back to 2009 for that period. We're still waiting. There's a big lag in population growth, even from a state level, from the ABS, but we're still thinking pretty reasonable population growth for your shire in the next year. Domestic wise, you tend to actually lose people from your shire. You tend to get people from your northern kind of suburbs, Canterbury, Bankstown and Bayside and those places, and then lose it to the Illawarra type region. Overseas migration, as I said, is overwhelmingly typically led by China. A few younger people from Brazil and places probably hanging out in Cronulla and those sorts. But yeah, pretty strong overseas migration in that period. What it means for your demographics in terms of age? Well, your overseas migration is fueling that growth in your 25 to 44-year-old bracket. Your growth in the kind of 70-year-olds, the older residents, is actually just people aging in place. So you're losing some of the older people to the Illawarra region and below, but there's a lot of people actually aging in place. And what we've seen this across Australia is this baby boomer generation, which was like the largest kind of demographic cohort in history in Australia, moving its way through the age brackets as it go on. So people see 70, 79-year-olds booming and they think, oh, people are moving in here are old. No, it's not. It's just that demographic bracket moving through the ages as they go on. And they'll be there probably for the next 20 years or so, and then we'll start to see, unfortunately, them start to move on into yes, what happens next, pretty much. But we're seeing kind of a bit of an exodus during that 2016, 2021 period of 20 to 29-year-olds. A lot of that was led, because we're running off ABS data, a lot of it was led from COVID exodus of international students during that period. Building approvals, pretty solid. I haven't seen a shire actually like this, which is pretty solid, operating at around the same levels over the last 5 or 6 years. In terms of the value of building approvals. In the non-residential areas, it's most dominantly led by retail and wholesale market, which is unusual. Usually you get spiked in shires in education and health kind of approvals, especially in the last kind of 5 years. But in your area, it's kind of retail and wholesale, which is means it's more the private sector. I chucked in the side here. Some people often ask us about working from home, what's happened post-COVID, and we're definitely not still at COVID levels of working from home. But generally what we've seen is we're running at kind of 25 to 30% below pre-COVID levels in terms of public transport and also kind of car movements as well. So generally say there's a lot of professional workers in the area who go into the CBD and they're working those hybrid workplace agreements, and despite people's talks about policies of getting people back in the office, a lot of that was just media kind of things. They are trying to encourage people back in, but most people are still working hybrid situations. Usually about 2 days at home, 3 days in the office, or even 1 day at home. So yeah, running probably 25 to 30% below transport levels of what they were pre-COVID. So there are definitely more people at home. This is interesting. So this is the Commonwealth Bank produces spending insights every quarter, I think. And I've kind of bunched this by looking at your demographics in your area. So in Sutherland, you have quite a high rate of people who own their house with a mortgage. So 39, almost 40% of people. 36% people own their house outright, and 22%, lower than the Sydney average, are renting. And generally what we're seeing, people who own a mortgage and people who own their house outright, the biggest kind of growth in the expenditure in the last year was insurance. So insurance premiums went up pretty high, and a lot of their expenditures growth has been in that area. But they are also spending more on recreation and hospitalities. People own their house outright. Generally, the demographics we're looking at there is the older population and a lot more of that baby boomer. They're spending a lot on recreation and food and beverage as well, more on grocery shoppings, big growth in health as well. But there's still a market. They're getting out there. They're spending money. So they're not sitting at home. They are spending money on recreation as well. What we've seen a fallback is in transport costs, and some of that is based on those, especially the owners with a mortgage, working families, more people with ability to work from home as well. Utilities spent less on. Part of that is to do with those energy rebates. Young people, typically more renting ones. What are they spending on? Well, the highest expenditures, hospitality. So they're still getting out there and spending a lot on hospitality and recreation, and digital. Their mobile phones and stuff is where they're expending expenditure as well. So what's the outlook kind of going forward? Slow and steady. So still quite tough conditions, as most people in businesses would know. We have had one interest rate cut. People are predicting a couple more. That will certainly help people. The tax cuts that kind of started last year, but are moving based on this financial year, and we'll start to put a few more dollars, and they already are putting a few more dollars into people's bank accounts. And there is real wage growth as those inflation falls. So it should, by right, start to help local spending and retail spending as well. But it has been a kind of tough few years, and people have started to dig into the savings for things as well. Continued population growth, but will place, theoretically, should place downward pressure on wages as there's more people in there, especially in some of those areas like retail and hospitality. If you're getting more international students, can compete for those jobs. There's a lot of planning incentives, a lot of incentives around increasing housing, especially around the transit-oriented development areas. There's talk about incentives as well, but it's whether those developers won't go in unless they get the right conditions for construction costs, and they feel that the market will go up. Basically, it's the forecast. If by the time you complete your product, you're going to get more for your sales, then you'll start to invest. So hopefully those conditions start to turn around. There are some regulatory changes that people need to take into consideration, especially around employment kind of law as well. But I'd finish with saying there's opportunities in any market, and that's why we have our demographic and economic data freely available. There's always opportunities for what's happening. Looking at the trends, working from home, as I said, the Chinese immigration, looking at who's moving into the area as well. The baby boomer market is still potentially got some growth areas there to tap into what they're spending their money on as well. Female employment, as I said before, there's more people, independent females now there with employment opportunities, which means they've got income streams as well to spend on. But it also means there's also going to be demand in families for childcare going forward as well. And for all those other household services that dual income families don't have time for anymore. Point is, you've got to leverage tech as well. There's, I talk about drop shipping there, but retail is moving to the online space, and the kind of there's trends in that market as well, taking advantage of AI. A lot of people are investing into AI, but not quite sure how it's going to support their businesses. I'd say, draw on support networks, local business networks, and how you can integrate it best in your business as well. But yeah, the outlook looks reasonable, but all this is contingent on global conditions as well. As we know, what's going to happen to tariffs, no one knows, whether it's all talk from the US to try and get better deals from other countries, or whether they're actually going to go through hard on some of those things. China's still trying to pump their economy this year as well, because they're afraid of it going flat as well, their market. But if some of that pumping falls away, then China will fall back, and then we'll get changes to our demand for our exports, which will affect our Australian dollar as well, which will raise the price of our imports going forward, which will raise the costs, and we're back to a kind of high inflation environment. So that is a possibility. But yeah, I'll finish there and pass back to Jeremy. But if you're interested in any of our products, or also if we can help you, we do a lot of population forecasting, finding demand for your business or your industry that you're operating in. Thank you.
Well done, Keenan. It's awareness is our first point of power, and you shared some really good data there about really what's to come. And the slides available?
Yep, I'll send them around.
Okay, that'll be fantastic. Well, we'll send a follow-up email with a link for people to download them. And, you know, it's a bit like when you're surfing. If we're surfing, we need to look at the waves that are coming, and we need to paddle before the wave actually hits us. And that doesn't mean you all need to run out and actually start a medical business, which is where we see, you know, a huge amount of investment going. But what it allows us to do is to think about those sectors that are thriving, and how do we target them with our business? Because any growing business, there's a lot of opportunities that are created, as well as a lot of challenges that come along with growth. So we're going to now slide into the real estate portion of this presentation. And it's my great pleasure to, I'll introduce both of them. Vanessa first, who's the head of research at Ray White. She has been for the last 10 years. She regularly appears in the media, and you know, real estate has always been a great passion and a great wealth building opportunity for Australians. So she's going to share with us a little bit about what she sees on the horizon for the real estate market. And then we've got someone with boots on the ground, Brad Lord, commercial real estate specialist, also the president of the Chamber of Commerce down in Sutherland. And he's going to bring the focus in a little bit more to specifically what's happening around the Sutherland area, some of the things that he's been seeing, and also some of the insights around business. So Vanessa, is it okay if I pass it over to you?
Yeah, for sure. Welcome everybody, and I'm happy to be talking today. I'm taking a view on the commercial property market, so we'll leave the residential for a completely another day, but given we are all business owners here, I think you need to just go back one slide, Jeremy. I think you flicked through. No? Okay. No, we'll go on to the next slide. So I'm here talking today about the strength of the commercial property market, or kind of a few bumps in the roads we've had over the last couple of years. During COVID, we did see a huge increase in the amount of demand to purchase commercial property. However, interest rates obviously were very low. People were diversifying their portfolios, and we did see this kind of huge jump up. The last 3 years, though, we have seen total volumes come back a little bit. In these last 12 months, so 2024, it did tick up a little bit. And this chart here just shows the volume of transactions, which was about 76 billion, which is a huge amount of money. But to give you some sort of insight, in 2020, that number was closer to 100 billion. So we have come back a little bit. This number is up a little bit last year because there was a number of large office transactions. So if you're talking about a Sydney CBD office transaction, if you like, it's a $500, $600 million beast. So you can understand that those numbers can skew the data a little bit. But if you look at where these transactions have occurred, in the last 12 months, it's actually been 52% of them have been in New South Wales. So in prior years, we did see a big swing, while New South Wales and Victoria are always kind of leading the charge, a really big swing towards Queensland and WA. The huge population increases that were there, the growth in business, the need for new development, the need for everything new. If you have a population growth as strong as they saw up there and out there in the West, all those supplementary services, be it office, retail, industrial, medical, childcare, there is need for that. So we did see a huge jump and spike in terms of investment demand in those locations. But like I said, the last 12 months, come back to New South Wales, forget Victoria, they've got some land tax issues down there, but we did see a whole lot of investment into New South Wales. In terms of asset classes that we're investing in, this chart's really interesting because it shows nearly 40% has been in industrial. And over the last 3 years, that number was probably bigger, closer to 50%. And like I said, those office transactions last year did skew those office numbers a little bit, because at the moment, who would want to buy an office building? I think I can say that in this circle, if you're talking about a big CBD very expensive office building. So industrial has been the asset class of favour over the last couple of years. You can understand why. There's really a limited supply of industrial stock. If we talk about just New South Wales, very constrained market. We only have so much industrially zoned land that is developable. There's not a whole lot of vacant sites around that are industrial. So as a result, our vacancy has been quite low. And when there's been low vacancy, rents have increased. So there's been huge demand, like Keenan said, with off the back of e-commerce, small businesses looking to occupy industrial property. And as a result, those huge rents, we saw values increase quite substantially while the rest of the market did see some correction in prices. In the last 12 months, though, we have seen a rebound in retail as an investment class. Like Keenan said, we did see a huge move towards online trading during the COVID period, and we do see spikes in that November period, which is really quite interesting because they're such huge spikes. It's really interesting to see due to Black Friday sales. However, the level of growth over the last 2 years have been pretty limited. There's only been like a little bop along, pretty stable in terms of our online trade, which is interesting. We do expect to see it to continue to increase, but people are going back to stores. We're seeing centres, if they're small centres, small neighbourhood centres, maybe like a convenience, you can drive in, go to do your grocery shopping, maybe some fresh food. Those sort of centres are really, really popular. We know the big, Westfields of the world and stuff are really trying to change their footprints to make sure that they are kind of entertainment based as well as just clothing, soft goods and those sort of things that have been doing traditionally quite poorly when it comes to bricks and mortar. But we are seeing a bit of a revival when it comes to retail strips, but it is very, very location sensitive. Some of our retail strips have seen really, really low vacancies, and we continue to see, while there hasn't been perhaps rental growth, but it's great to see some occupancy in those strips that, excuse me, that we haven't seen in the last little while. Another interesting part is the development site market. And development sites, again, off the back of what Keenan was talking about with the construction costs have been quite difficult to get off the ground. So we have seen development sites kind of being a small part of the market. We're seeing a lot of people that perhaps overpaid in prior years, having to offload some of those sites. So a bit of an interesting part of the market to watch, particularly with some of that zoning changes through the new housing reform that just came out the other day. We may see some smaller sites that can provide infill development quite attractive and a bit more activity happening in that this year. In terms of just going through some of the others, I like to call it hotels, accommodation hotels, always a big draw card for international investors. Pubs doing really well, probably record year of transactions last year. Service stations still appealing. They've got really long leases. They're kind of set and forget assets. We call childcare assets the same thing. Set and forget. You have lock into a long lease term, and those occupiers are there. There is demand for the space. Despite everyone worrying about EVs, they represent about 9% of the new vehicles sold in the last 12 months. And in terms of the entire population, if you like, of vehicles, in terms of registrations, it's still less than 2%. So service stations will still be here for some time to come. So they are still an attractive investment. Medical, as we said, growing population, aging population. It's really important that we have those medical facilities and that is growing, and there's a lot of demand to purchase those assets, particularly by owner occupiers, be it GPs, dentists, are trying to have their own piece of their property. And then housing. So like I said, some of that infill site boarding houses is something that's been quite interesting across the state, particularly New South Wales, and PBSA, which is student accommodation, purpose-built student accommodation, which is getting in our major cities. If we move on to the next slide here, Jeremy, it's really interesting to look at who's buying what in different price ranges. So let's probably just concentrate on the sub 50 because that's and even to be fair, this chart looks quite similar when it's sub 10 again. And we can see that the private market has been doing the heavy lifting in terms of the transaction activity, more than about 3/4 of that total market. Again, very heavily industrial. Industrial has such a huge price point. So you can go from the large data centers or self-storage facilities or those kind of big logistic type uses through to quite a small storage unit or a small industrial unit. So that kind of wide range of value is attractive to private investors, no matter what their price point is. Also, because of those huge growth in rents, we've seen owner occupiers really jump to the market really quickly, particularly industrial and to some extent retail as well, just taking control of their own destiny, perhaps purchasing through their self-managed super funds. And industrial is a real key one for that. They don't want to be locked into leases that may see some escalation in rents, particularly the constrained nature of industrial. And Sutherland Shire is probably a really good example of that, really constrained industrial supply. With lack of zoned available land there to continue to grow that industrial market. So we expect to see that private investor market and also that owner-occupier market continue to grow, particularly in that sub $10 million space and sub $50 million. And we can see at the complete other end of the spectrum, those assets over $100 million, we're seeing foreign buyers really converge on Australia. We've got the combination of the dollar, which looks really, really attractive. And, there's been a big turnaround in terms of values when you talk about big assets like office buildings that have, had a bit of a rough trot when it comes to work from home. So vacancies are quite high, rents have come backwards. Some counter-cyclical buying happening in that end of the market. So onto the last slide. I'm only taking a short time so Brad can really delve into what's happening locally. We expect that interest rates will continue to fall this year, and that will stimulate a little bit more activity. The availability of funds and financing obviously key to being able to purchase and transact in this market. We did see a period of times where, which is probably going to continue, we're seeing interstate buyers chase yields, chasing those returns. So that's why we did see a lot of movement in Queensland and WA, particularly from kind of the New South Wales and Victorian investors in the last little while. So yeah, that will continue to happen. I think that really good quality assets that have really good fundamentals, if they've got a tenant in place that is locked in, good kind of rental growth projections, or if it's an owner-occupiers are being more aggressive than the private investors because they're just looking to secure their future. And commercial property is an investment, a long-term asset. Those that are trying to ride a wave of things going up and down often do get burnt. But buyers that are looking for their own property, for their own business with a long-term view, tend to come out on top when it comes to that. More investors are pivoting to retail. Industrial was definitely the flavour of the last 5 years. Small retail also at an attractive price point, but however very, very clear, location sensitive, tenant sensitive also. But it's good to see that people going back. It's also in terms of tenant, it's food, it's services, it's no longer clothing and soft goods. To some extent, there is a recreation component in there, again, similar to some of that data that we saw on retail trade. Office, if you've got lots of money to spend, there's some good buying out there. It's a tough market and it will continue to be tough for a little while to come. And the large scale development sites continue not to stack up, so we really can't get those out of the ground. The high construction costs, the lack of labour as well on those sites, together with the values, while there has been some change in values and growth in values over the last, say, 5 years, still not kind of feasible. But we will probably see a little bit more of that infill stock again, leaning on those changes to the housing reform that just came out last week. So yeah, it'll be an interesting time for the commercial property market, and hopefully I've kept into time, and I'll hand over to Brad, if that's okay with you, Jeremy, to talk what's happening locally on the ground in the Sutherland Shire.
Yeah, that was fantastic. Thank you, Vanessa. It's commercial real estate. If you're in business and you have the opportunity to buy your own premises, I think it's just one of a great risk mitigation strategy, a great wealth building strategy, and it's a good thing to build into your business plan. So hopefully you've got people thinking a little bit more around what's coming. And I think with Keenan's presentation first, when we see some of the demographics, Australia's population is going to continue to grow, and that's going to drive all sorts of opportunities, not just in the retail sense, but very much so in the property sense. So Brad, over to you.
Thank you very much, Jeremy and Vanessa and Keenan. Wonderful presentations, as I would have expected. Look, I generally like to talk about where we're at, what we're doing, what's happening in our market. As Jeremy mentioned, yes, owning your own property is a way to ensure that you keep certainty in terms of your business and where you go without the variability of your leases. I will just start off, before I get into what I was going to talk about, just backing up a lot of the data that Vanessa said and digging this down to a more local base. So what we saw over 2024 was 110 transactions, total sales volume of about $216 million. And of those transactions, 48 of those were actually in the warehouse and industrial space. So again, really backing up what the data said. As Vanessa also said, that retail was probably closely therefore followed. We actually had 21 deals that were done. That's across the Sutherland Shire in 2024. If you aren't in that position where you are fortunate enough to own or purchase your own property, I've got a couple of quick things that I do want to run through, which will help both tenants and also owner-occupiers. First and foremost, if you're not sure about what commercial is, think shops, factories, and offices. We do tend to rely on jargon, but at a layman's term, that's exactly what it is: shops, factories, and offices. If you've been in business for the last 5 years, congratulations, well done. It was the hardest time ever to run or start a business, so well done. Interesting data to back up what Jeremy was saying as well, where December actually saw the highest amount of insolvencies for businesses ever on record, 3,852 businesses. I mean, look, small business does all the heavy lifting in this economy, in this country, as we all know. So I've got a quick fast five I'm going to run through to ensure you don't become one of those casualties and to underpin your business. First and foremost, know your numbers. I echo Jeremy, having a business coach is an excellent way to get out of the day-to-day running of your business and actually concentrate on actually running your business. But knowing your numbers, if you're stepping out from your home office, if you're growing your business, if you're moving premises, whatever it is, make sure you understand where your costs are. We typically see that affordability of rents to your turnover is about 5 to 10%. Some businesses can sustain a little bit higher than that, around the 15% mark, but 5 to 10% of your actual turnover is what we would consider to be an affordable rental position for your turnover to ensure that you will sustain the longevity of that lease. A couple of things to know: if you are looking at trading up, you'll need to pay a month's rent in advance, and you'll also have to have a bond in place. So typically they're around about 3 months. So if you are looking at growing from where you currently are or stepping out of the home office, you're going to need to have significant surplus cash flow in order to make that next step for you. If we go on now about managing your risk, so look, leases are a large document. They're pretty daunting. There is a lot of business and personal risk that you do take on. It is an investment in your medium to long-term future, with most leases being in that sort of 3 to 5 year period. A couple of things, and look, excuse the landlord side, I've got to look at both sides here. So if you're a tenant looking at doing this, there are options which are available. You do have some things like rent freeze, potential break clauses that you may be able to negotiate with the agent or the landlord who you're looking at the space with. If you're a landlord, you obviously want to make sure that you have a tenant for the duration of that lease. So potentially working with your tenant and sharing some of that risk up front is a really good way. Tenant-wise, don't overspend on your fit out. At the end of the day, every commercial lease has a make good clause at the end. The amount of times that over 24 years I've heard tenants say, "Oh, but I spent X amount of dollars on my fit out 3 years ago." At the end of the day, your lease requires you to take that back to its original condition. It's very, very different from the iron stain on the carpet of your residential property. Commercial actually does require you to make good at the end of your lease. In essence, it's not worth anything. As Vanessa mentioned, rents have grown astronomically over the past 5 years. We've certainly seen that. Interest has grown as well, but what I actually found really interesting was a correlation between the two. So while rents have increased and interest has increased, the serviceability and the affordability is actually pretty much line ball. So whether you're a business or an individual, the rent that you're paying is very, very similar to what the interest component was if you were in a position to buy your own premises. So I was actually at an appraisal yesterday. We were looking at they're an owner-occupier. We sort of looked at it based on an owner-occupier purchasing, and also if the tenant was to remain there long-term, what would be sustainable for the business. The number came back at 70 grand each, for both sides. Now, obviously, you do have to put some capital in up front. The banks won't loan you 100% of the purchase price, no different to residential. But what I actually did share with the team prior to this was that there is a bank who's actually jumped into the commercial space, offering a 90% loan to value ratio. So effectively, you've only got to put a 10% deposit down. They're doing a 30-year loan term. Now, typically in commercial, we'd only seen loan terms of 15 to possibly 20 years. We're now seeing that pushed out to 30. But in addition to that, they're also offering a 10% interest only period as well. Obviously, if you're making that big jump, it's where you go. The other thing as well, in terms of values of real estate, typically the property is valued based on the level of the rent that you are paying for that property. So if you're, an investor and you're looking at, what sort of return you're going to get, you're going to be limited in terms of how much interest you've got to pay. You don't want it to be, negative geared or things like that. If you want it positive geared, there's a few technicalities around those sorts of things, just to be mindful of. There is a big difference between residential and commercial. Largely, it relates to GST. So if you own your own home, principal place of residence doesn't attract GST. If you are looking at purchasing a commercial property, GST may or may not apply depending upon how you purchase the property. Now, you might say, look, I'm not registered for GST. I'm buying it, in a certain fund or a certain vehicle or an SMSF that's not registered. We can't solicit nor provide advice. We're not allowed to as agents, but I would say that always go and seek advice from your financial planner, your accountant, your solicitor, and so on. But if you aren't registered for GST, it would be a good idea to register for GST, in particular if you are buying a property which is vacant. Now, the way that the GST is applied when selling a vacant property is it's deemed as though you are physically receiving the goods. Therefore, it is a taxable supply. So if you're buying a property of, say, $1 million vacant possession, you will have to pay 10% in addition to that purchase price. It is something that banks won't loan you on, so you've got to think really hard about your cash flow. As I said at the top of this, knowing your numbers is really, really important. So you will have to pay that and then obviously claim that back whenever your BAS period is. One thing that I think is a really, really good option, where we're finding a lot of success at the moment from purchasers, is purchasing properties that have a short-term lease or a balance of a lease in place. One, it's going to stack it up from a serviceability perspective, so the banks won't just take your income in your business or your individual income. They'll also assess the rental which is being paid for that property, so the serviceability will actually assist in the borrowing capacity. But second of all, the contract of sale effectively will remain the same except for one very, very important box. And that's the box which says a going concern. Going concern means you can't physically receive the goods, so therefore there would be no GST applicable on the purchase of that property. So as I said, if you've got something which has got, say, 12 months, 6 months thereabouts left on a lease, and you're thinking of moving or jumping in and owning your own premises, it's a great way to do so. Perhaps an easier option would be to approach your existing landlord and offer them to purchase the property that you're already in. Your lease is already set. You know exactly what the property is. You know it's fit for purpose, and you know it works. And you can also use your own rental income as a way of serviceability as well. The last point that I did have here is about, can I actually really own my property? So I've touched on a few of those things around serviceability. The one thing that we have found, obviously with interest rates going up, in particular in the residential sense, is that borrowing capacity reduced. Because banks are only looking at what you can afford based on your actual income. What will actually happen around purchasing a commercial property, if you're going to put your own business in there, or if you're thinking of investing, is actually taking your personal situation, but also whatever income is being generated from that property. So there's probably two ways that banks will look at that. The other thing to look at is, how do you want to purchase a property? There are significant benefits for people who want to keep things separate. So we're seeing probably top and tail of the market. And what I mean by that is, there's a lot of people who are jumping in purchasing properties at the moment from us and from other people who are setting themselves up for a future, and that is that they buy a property for themselves to own or operate out of. They're paying themselves the rent, they're meeting the serviceability requirements. By the time they get to that retirement age, they've got a beautiful asset which they've cared for over the course of their business life. They are at the stage where it's time to retire. The property is fully paid off and it becomes a cash flow positive asset into retirement. We're also seeing a lot of our sellers at the moment getting to that stage where they're sort of hitting that magical 60, 65 number. Financial planners would like to deal with cash as opposed to property. The younger generations are obviously looking at that as well, thinking that, at the end of the day, there may be some inheritance and things like that there. It's a lot easier to carve up cash than it is property because things get tied up with probate. But we're seeing a lot of, in particular, sales that we're dealing with where people have run their business out of a property, they've owned it for a long time, they've sold the business, the business has continued to pay them rent, for a period of time after they're out of that business, and then they're finally going, right, time to clip the ticket and get out and sort of just live a happy and merry life. So I think that, as Jeremy sort of said, and I echo that, not just because I sell real estate, but because it is a really, really sound way of future-proofing your existing business. You already know your numbers. You're already paying the rent. Why not pay it to yourself and own the property and have the benefit of actually a growing asset over the course of your lifespan? Vanessa did touch on as well, there are some changes that are happening at a state government level in terms of density around train stations. So those people who are fortunate enough to buy, in locations that weren't as desirable at the time, but sort of, maybe fit for purpose because your favourite cafes are across the road. There are some people who are going to make some significant financial gains, not through being, astute, but just by owning real estate, and that's sometimes the lottery of what it is. Again, I'll just in closing, understanding your risk, keep your costs low, know what you're committing to, seek advice from professionals like your business coach, like your accountant, like your financial advisor. Obviously, reference the data that my colleagues have shared with you today. But I just encourage anyone to think about what it would mean if nothing changed, but you end up owning a property at the end of your lifetime, in your business. I mean, it'd be a wonderful thing if we could all be in that fortunate position, and you can live off the cash and the fruits of your labour over the course of your 10-year life cycle.
Fantastic presentation. Thanks, Brad. And I think that risk of inflation, I had a client the other day, had been on a 3-year industrial lease. And as many people are aware, industrial property is in very short supply. And they got hit with a 48% rent increase to get back to market. And
Yep.
well, there's things...
They're not pleasant conversations, I can assure you.
But at the end of the day, we don't get what we deserve, we get what we negotiate. And to have a good agent on your side and to be willing to negotiate, these things... We were able to negotiate significantly, but again, this is part of planning for the future. We do need to stress test because you spend too much on rent and you won't have a business. I'll just share my screen. So I wanted to delve in a little bit to strategies that as business owners we can put in place to really minimize the risks depending on what's coming our way. And if we listen to the mainstream media, we tend to get a lot of fire and brimstone, and it's easy to get discouraged or disparaged. But I want to talk about some of the things that we really specifically can focus on that will allow us to, I think, take the positives away from the environment as it is. Just looking at the state of small business in Australia over the last couple of years, we've seen a rise in business exits, but we've also seen a rise in business entries. So there's plenty of people willing to jump in and still start small businesses. So we're in a net positive space in terms of businesses, even in these really tough times. And one of the things with business operates in cycles, a bit like the seasons. After summer, we get autumn. After autumn, we get winter. And let's just say it's been a little bit of a long winter, but we're looking forward to a little bit of spring coming our way. And with Keenan's presentation, I think there's a lot to be optimistic about and to also plan for. According to the Australian Banking Association, the primary reasons for small business failure, number one is insufficient leadership and management. And this comes down to being clear about, as the leader, where your business is going, how it's going to get there, and putting the right team around you. Second one, not enough market research or poor financial management. And we're going to dive a little bit deeper into each of those. If we look at, Brad mentioned in December, we saw one of the highest levels of small businesses going out the back door, and looking at risks, they're forecasting, well, if we look at the food and beverage, it was almost 8.7% is the average business failure that they're looking at for 2025, followed by arts and recreation services. So, while about a 5.5%, 1 in 20 businesses that's in business now won't be in business by the end of this year, we need to understand what some of these business risks are and how do we mitigate them. I want to start with a thought. There's no such thing as an unresourceful person. There's only unresourceful states. And it's very easy as business owners, when we encounter challenges, when we come across bad news, to basically get into an unresourceful state, to get quite negative about what's happening and the impact on our business. But what you will find about successful business owners is they tend to be the optimists. It's not the glass half empty, it's the glass half full. Let's make the most of the opportunities that are out there today. So today's been a little bit about, prognostication, looking to the past, but also looking forward into the future. And where our mindsets need to be for successful business owners. Spend too much time talking about the past, the good old days. I missed the opportunity to get into real estate. We get depression. Spend too much time stressing about the future, things we can't control, we get anxiety. The only point of power that we have as business owners is right now and today, the present. So this is where it's really critical that we understand, well, what are the things that really matter to the success of our business? But more importantly, what are the things that I can control? What are the levers in my business that are going to allow me to stay viable and stay profitable? So part of any business plan, we normally do a SWOT analysis, looking at the strengths of the businesses, the weaknesses, the opportunities, and also the threats. And usually the threats is the outward facing things that could change about our business. But one of the things I encourage you all to do is to look at also some of the internal risks that you have in your business. What happens if something happens to your health and you're unable to show up to work? As a business owner, you don't get sick leave. So this is where it's really critical that we have personal insurances in place. If we're working with industries like the construction trades, and again, there's a lot of those go under, it may make sense to actually have creditor insurance in place. Or business interruption insurance. What happens if you get cyber attacked and you have no computer systems for a month? Would your business actually survive? If you want to build a solid business, you want to have a solid amount of cash. When you look at blue chip shares, why are they called blue chip? Because they have massive cash reserves behind them. And for a small business, I would recommend having at least 3 months of operating expenses sitting in the bank. And what that means is that you have some reserves when times get tough, but it also prevents you from bringing on the wrong sort of clients or from cutting our prices just to keep things turning over. A couple of other key business risks, protecting your intellectual property, not just your brands and your logos, but also some of the key ways in which you do business. Cybersecurity, or also planning for what happens if we lose key staff members. External factors that can place your business at risk. We talked about the economy quite a bit today. Legislation can change your business literally overnight. But likewise, you need to look at your ability to be able to continue to trade if you have changes in your suppliers. What would happen if one of your key suppliers actually went out of business? We're seeing a lot of changing consumer behavior. So these days, shopping online is the norm for many, many people. They don't want to go to a retail store. They simply click buy and it shows up 2 days later, and they're a lot happier with that. But two that I think that you need to really think about for your businesses is new competitors entering the market, and the impact of new technology such as AI, which can really change the dynamic. And it's really important with our businesses that we leverage the opportunities that are there to stay as efficient as possible. Because if you don't, your competitors will. They'll make profit, and you won't. Companies that are really jumping on board with artificial intelligence are seeing significant increases in efficiency, reduction in costs, continued growth. You know, the nice thing with technology is, again, once you've set it up, it's there for the future. And we can have automated agents that can help our clients on call 24 hours a day, you know, without paying penalty rates. We want to employ great staff wherever we can. But when you look at, you know, the traditional knowledge worker in Australia, a person working on a computer, about 70% of that time is spent on data entry. And these days, using AI, those sorts of tasks can be very, very simply automated. So if you haven't been looking at it already, make sure that you do spend some time to check it out. So over the last 20 years, spoken to a lot of business owners, the most common thing people will come and say to me is, Jeremy, how do I double my turnover? And I'll say, well, would you really want to do that? What about if we could halve your turnover and double your profit? And they're like, yeah, that sounds good. But the challenge is turnover and profit are things that we can't physically have. They're outcomes. Same as more customers. If you want more customers, you need to have a marketing machine that generates the leads, and you need to have a sales machine that converts those leads into customers purchasing from us. To go from customers to turnover, it comes down to how much do they spend and how often do they buy from you. And that gives us our turnover. And to get from turnover to profit, we need to focus on our profit margins. Those 5 numbers in orange are the only things you can really control in your business. And if you can't measure it, you can't manage it. You see, the secret to building a successful business is to know what the key levers are and to focus on increasing each one of them just slightly. And this is what's also called the winning edge formula. If we look at the Melbourne Cup horse race, first prize, $3.5 million. Second prize, $700,000. Is the first horse 5 times better than the second horse? And the answer is no, it just had to be that little bit better. So if we look at these numbers, take a small business that's generating 1,000 leads a year, converting 25% of them into customers, they're buying 10 times a year, spending $100 each time. We've got a $250,000 business that's got a profit of about $60,000. If we were to increase each one of those 5 areas by just 10%, our turnover increases 46%, our profit increases 61%. Did we have to change anything major? No. We just got a little bit better in each one of those areas. So I want you all to think about those 5 levers for your business and how they can help your business to grow. Get your marketing right, get your sales team right, get your operations right, build a successful business. So, a couple of points in these tough economic times. Number 1, don't waste all your marketing on attempting to bring in new customers. Step 1, love your existing customers. It's much, much cheaper to keep your existing customers happy so they come back and they refer their friends than it is to bring in new customers. Does anyone know actually how much you need to spend on flybys to get a free flight from Sydney to Melbourne? We'll say free in inverted commas. And it's somewhere in the realm of about $20,000. But do we still show up and show our flybys card every day? And the answer is yes. And the reason why businesses offer these loyalty programs is because they work. So have a think about ways to say thank you to your existing customers and to keep them close. Secondly, think about how you can get your customers to come back just one more time, whether it's rebooking their next visit or consultation while they're still here with you. So often, customers don't know all of the products or services that you sell. So selling doesn't stop once you've got a customer on board. Selling needs to continue time after time to continue educating customers, to get them across to other services, and to get them to come back and continue to support your business. This is one of the simplest ways in these tough times to increase your business viability, and that's to look at your average dollar sale. I worked with a deli that was Their average dollar sale per customer was about $8. And all we did was we trained their staff. When someone came in and bought cheese, we offered them pate and we offered them biscuits. Their average dollar sale doubled. Their turnover doubled. 3 words we taught their retail team. By the way, we've got some great crackers to go with that cheese. Would you like some? By the way, we've got this new pate in from Hungary. Would you like to try some? A little bit of salesmanship goes a long way to building a profitable business. So putting in place things like actually testing and measuring this, sales scripts, so training your team how to do customer service, teaching them how to upsell and cross-sell. All of these sorts of things are fantastic to increase your average dollar sale. My favorite strategy of all is conversion rate. Why? It doesn't cost a cent. I worked with a builder and we had 3 times we had meetings and 3 times he cancelled on me. He said, I'm too busy. The 4th time he rang to cancel, I said, it's too late, I'm sitting in your driveway. So we had a cup of coffee and I asked him, why are you so busy? And he's like, well, you know, the phone's ringing all the time. We're a family business. We've been around for 40 years and, you know, I'm just doing quotes, sending them out. I can't keep up. And I said, well, what's your conversion rate? And he said, I don't know. And I said, well, you know, there's your pile of proposals. Let's go through it and actually have a look. And we did the sums and he was only converting 10% of their inquiries into sales. And for each inquiry where we put a proposal together, it was like 1.5 to 2 days work. So all we did was we put a sales process in place. Number 1, to actually screen the inquiries. Not every one of them actually needed a proposal. Number 2, to stop him, because he'd generate a proposal and he'd go around and stuff it in someone's letterbox and then just wait for them to call him back. He thought, well, they know where we are. They'll call us if they need us. So we put a follow-up process in place to say the proposal's ready. Let's book a time for you to come in and see it. Conversion rate went from 10% to 30%. His business tripled in 12 months. Total cost, 0. So have a think about conversion rate. Be more efficient with our sales. Your business will go through the roof. For many businesses, this is also offering a satisfaction guarantee for first-time clients. How do we reduce the risk when doing business with us for the first time? So just because your business has been a certain way up until now doesn't mean it has to stay that way. So this is one of my clients, Blake, who when I met him 5 years ago, it was just him and an offsider working out of his home office, turning over about $500,000 a year, working about 80 hours a week. And he's like, Jeremy, I need some team. I can't handle it anymore. But the challenge sometimes when we grow a business, we grow the number of headaches. So the thing we got back to was, well, what market do we really want to target? And he'd been specializing in residential gates. It's $3,000 per system, but you're dealing with the public. There's a lot of argy-bargy around price. People always want a discount. So instead, we focused on how do we do commercial systems? How do we get into new technologies like ANPR, car park access? Average sale, instead of being 3,000, is now more like 50,000. Did we have to change a lot? No, we just got clearer on where were the trends, who were our ideal clients, and how do we build a brand around that. If you're feeling the pinch, be aware your team are as well. And at the end of the day, your biggest asset in your business, it's not your customers, it's your team. Make sure your team feel loved. Make sure you're creating a vision and a bright future for your team. If you can do that, if you can build a business that builds people up and supports them in their career growth, you'll become an employer of choice where people actually want to come and do work with you. Likewise, when we have a budget, if we recognize that we're too cost heavy, sometimes we do need to let some staff go. You know, as a business grows, it doesn't always need more staff. Sometimes it just needs better. But we need to be quite compassionate and in the way in which we do this. We're dealing with people, we're dealing with lives. But that's why it's really critical that we build a business that's growing. Growth brings all sorts of opportunities. As I mentioned at the beginning, if you're interested in a one-to-one to talk a little bit through, I guess, the impact of some of what we covered today, I'll put a link in the chat and you can book yourself in for a business growth discovery session. If you've got questions for council, I've got their email address there, but we've also got Justin Sokolowski here with us. So you're able to ask questions through the Q&A, and we're going to open up the forum in just a moment. I just want to draw to your attention as well that there's another 2 webinars coming up. So the first one at the end of March, specifically on the topic of marketing. How do you boost your business presence and appeal in a competitive market without spending a fortune? So we're teaming up with Christy from the Collective to deliver that webinar. And at the end of April, we've got a special guest, Kim Sealing-Smith, talking about the recruiting and retaining a skilled workforce. And we'll also have Kelly Salmon from Growth HR. So stay tuned, on the lookout for those events. So let me just stop my screen share. And I'd love to put a first question to the panel in terms of what are some of the things you've observed that are about businesses that continue to succeed, even in times of economic challenge?
Feel like this might want to be one of your questions, someone else.
Brad?
Yeah, okay. I can jump in. I was going to wait for the other guys with the facts and the data in there. Look, the biggest thing that I've found in this is that, look, so I started this business 6-7 years ago, right? So that 5-year period I mentioned earlier, being the hardest period ever, you know, it's something that, you know, we're kind of testament to, you know, being resilient. And a couple of things, you know, really stand out for me. Really keeping control of our bottom line was so important. So times we went to grow, times we went to move, chose not to because we just didn't know what was around the corner. Certainty is a really, you know, important thing. It's, you know, it's your friend, but also authenticity. I mean, people buy from people who are authentic. You know, your barista knows your name, they know your coffee order, or the good ones do anyway. That's why you keep going back. You know, it doesn't matter what business you're in. I think they're fundamentals that you need to continue, you know, long term for success.
Yeah, that's a big one. You've got to manage the risk. If you're not willing to take a risk, you're not going to get the rewards. But being smart around doing that when you're going for the new premises, instead of going for something twice the size straight away and just saying, we'll fill it, making sure you've got a proper business plan to make sure that if you don't fill it, can we sublet it to recoup some of the rents?
Yep.
I'll just come in terms of more of a kind of, I guess, IT or software service type businesses stuff is it's the ones who listen to their clients basically. So if you've got touch points with your clients every day and constant and putting in mechanisms to get that feedback, which some businesses do get the feedback, but then they don't do anything with it actually. And it's really kind of, especially in a competitive market space now, if it's an online-based business, when anyone can come in and disrupt you, you have to be listening to that customer feedback and then updating your services to reflect what the client is doing on a pretty kind of quick basis. And the other thing would be, if you're trying those new ideas, it's failing fast. In terms of putting a little bit of investment into something, seeing if it works with customers beyond the ones you've just chatted to, and if it is working, put more investment into. If it's not, shut it down. Don't spend too much. So don't hold on to something that's failing. So,
well, I think that's the big one. Is like Gen X got promoted because they knew their stuff and didn't stuff it up. But in business these days, we've got to be willing to, as you said, fail fast, to test some of these new technologies, to get out there. And this is going beyond our comfort zones, but it's really what's required to make sure that our businesses continue to evolve. And there's a reason why Apple and Samsung release a new phone handset every year. That reason is to give people something new to buy. And it's really important that we look at our businesses as well and think about, well, what does the next evolution of our products look like? How do we create something new that's going to appeal to the marketplace and the appeal there? Anything from your front, Vanessa?
I think probably just off the back of what you were saying, Jeremy, with knowing who your customer is. I think that too often you think your customer is someone, but it really probably maybe it's not, or maybe there's a pivot to something else, which is going to be a far more lucrative kind of customer. So yeah, I think that that's super key for business. Even with the work that I do, I have to understand who's my reader, who's my audience that I'm actually targeting to, and sometimes it's not who I necessarily thought it was. And then you have to pivot quite quickly to make sure that you're providing the right service or the right information to the people at hand. So yeah, know your customer is absolutely key.
Do your research, survey your customers, but sometimes take the survey feedback with a pinch of salt. They say they'll buy it and then you make it.
Well, that's when you learn to fail quickly. Like that's the thing, is you tend to, particularly technologies and things, you like to hold on and like, oh, can I make it work? Can I make it work? But you know, sometimes it's better to cut it straight away and just kind of move on to the next thing.
Keenan, I've got a question on what's your opinion of the impact to our economy due to changes on the US international trade policies? Yeah,
I mean, what a big question. I mean, it's what everyone's thinking at the moment in what's going to happen there. Anyone's guess is as good as mine, but generally, I mean, moving, the general argument is if you move towards higher tariffs and stuff, you generally increase prices across the prices of trading, basically, which is building prices across and it flows across the economy. So you end up having inflation, where costs based on that. The other thing is if there's those tariffs are based on China, our main export partner. So there's anecdotally that the US, because we have a good balance trade balance with US, that's favourable for the US, that they won't go hard on us. But there has been talks about raising tariffs on steel and stuff, which Blue Scope is challenging at the moment. That could be bad for us. But if they're going hard on our trading partner China or anyone, and they start feeling the pressure there, then it'll flow through to us as well. And if China goes down and some of our export markets goes down, then it'll affect our currency, which will depreciate, and we'll be paying more for imports, which will be inflationary. So that's the potential that it comes. But there's a lot of things in terms of exchange rate. There's the other main thing that affects exchange rates is the interest rate differential as well. So people forecast what's going to happen with interest rates, and if interest rates in the US are forecast to go up, that can be depreciative for our currency as well. So yeah, I don't know where it goes. It depends how much. In Donald Trump as well talks a lot of talk, but then he kind of sets a target up here and then negotiates down to something a bit lower. So yeah,
very good at the art of negotiation.
Yeah. But trade-wise, anyway, I mean, as I mentioned before, some of our big, like China and stuff, was in a declining growth phase for a number of years. Well, it couldn't continue to grow as what it was, and it's been pumped up a bit by government. So yeah, so there's an expectation that we could have decreasing kind of. Definitely not the sort of commodity prices we had in the last couple of years in a number of areas. They've already started to fall back.
So question for Brad. As a small business owner, my fear has always been if I go to the commercial real estate agent, you're representing your client's interests versus my interests. Do you offer that advocacy service so you can be engaged to act on behalf of the business to make sure there's good decisions made there?
Look, very good question. Yes, we do. We're doing that at the moment for some brands that are looking at expanding, who have come into the Shire, had a really good experience with us and have said, hey, we want to use your services. Look, I also agree with the comment about, yes, we are engaged by the landlord. Look, we probably work a little bit differently to some of our competitors in a sense that I don't want to see tenants go in and fail, right? So we typically will lease the property and then manage the property. So if I put the wrong tenant into a property, I'm going to inherit a headache in my business. But also I don't want to have to go through that, the emotional anguish as well of having that conversation with someone, taking a risk, taking a challenge, trying to grow and expand, and then have that hard conversation. So typically we will go through a bit of a process to understand the business, understand the reasons why they need it, understand their cash flow, before we'll actually make a recommendation to an owner. But the deal will generally benefit both sides. So I hope that answers that person's question. So it's a little bit well-rounded, but yes, we do that stuff. But the only caveat on that would be that we do it at a larger sort of level, because we can't be sort of running around, gallivanting around, and not sort of protecting our bottom line. So again, know your numbers.
But the thing that strikes me with you is you're an educator,
Yes.
educating clients to make informed decisions.
Yes, correct.
One more question for you was, Jake's asking, what was the bank that you were referencing with some of those loans? Is it one of the big lenders or a second tier?
Yeah, so it was actually from my mortgage broker that sent it through to me. I understand it was Bank of Queensland, but it didn't actually come through on the email. I didn't want to give any advertising freely to any of the big banks or small banks, but I understand it was BOQ. But I just encourage people to go and speak to their lenders and see what is available. If you wanted to email me, I'm more than happy to share the email that I got sent from my broker, and you can have a chat to them as well.
I think when it comes to lending as well, Brad, like you'll find that there will be different lenders have different appetites in different markets and in different asset classes, because they do look at their own book and see where they may be overexposed or underexposed, or they're willing to lend. So you really do need to I don't want to say look far and wide, but if your banker that you generally deal with, then perhaps you can't get financing, you really do need to kind of shop around when it comes to commercial loans, because there is a different appetite for different banks, again, in different locations. It does change quite rapidly. And then also those LVRs can fluctuate from bank to bank as well on exactly the same asset with the same kind of terms. So we've seen that a lot. However, we are seeing more commercial lenders actually in business at the moment, looking and happy to lend on product today compared to a few years ago. So that's a good news story for those looking to buy.
Yeah, absolutely. I think it's a reflection of the confidence of the banking sector in commercial real estate moving forward. And, sometimes if something seems too good to be true, it can be, but it also gives you a point of negotiation, because if you're only going to one supplier, how much choice do you have? It's when we're looking at this sort of thing, we need to have a look at the marketplace across them and negotiate the best deal for us. Justin, I think we've got a question around if there's any plans for the Caringbah retail strip. I think you're muted.
That's a very good question. It's probably wait and see. The best place to look for that is on our Join the Conversation website. So you may have seen some new legislation proposed by the state government this week. So you'll see that up and coming soon. But we've also done precinct planning for many years, and Caringbah is one of those that you can actually review that on our Join the Conversation platform. And you can see what has been done so far in Caringbah and keep updated via that platform. So yes,
Fantastic. Thank you, Justin. And with that, I think we might bring things to a close. So I would love to thank our panelists. Keenan, great presentation on really what's coming with the economy, both on the national, state and local side of things. Vanessa and Brad, for your wisdom on commercial property and how do we really use that to our advantage in small business, and Justin for making this event possible.
Yep. And also from the council's perspective, to Jeremy, Vanessa, Brad and Keenan, really appreciate your time today. I think there's some really good conversations that have come out of this, which have come from our local businesses in that survey that everybody did last year. So really appreciate you spending your time supporting our local businesses. And like I said, this is what they wanted to hear, and it's great for you guys to come on board. So thank you to everyone. And it hasn't finished yet. We've got 2 more webinars coming up to target some of the other points that came out of that top challenges that came out of that survey. So to be continued. Thank you, everybody.